Okay, good afternoon, everyone. ESG investing is here to stay. There are 736 ESG ETFs globally benchmarked to various ESG indexes with AUMs of over 326 billion US dollars, of which 108 billion have been invested just this year. This is significantly higher than the total new assets flow of 88 billion during the whole of last year. So this year, just year to date, it's 108 billion of new money that has gone into ESG ETFs. Last year, that sum was 88 billion for the whole year. Back in 2019, the total AUMs in the ESG ETFs were just 66 billion. So let that sink in a little bit. What we are talking about is a 5x growth in investors' commitment to ESG in just the past 2.5 years. So ESG is not just talk. Investors are investing their money where their mouth is. Thank you again for joining us today to explore this exciting theme that we are all passionate about. I would like to welcome Hussein Al Abdullah to formally launch the proceedings of the day with a welcome address. Hussein.
Assalamu alaikum. Good afternoon, ladies and gentlemen. I would like to welcome you all to this online seminar in which we will be discussing ESG investing and how it has become such a dominant theme globally. Qatar recognized that sustainable development can only be realized when there is environment-friendly policy framework, social progress, economic growth with acceptable governance. Second, national development strategy aims to integrate the 17 sustainable development goals into various economic sectors. Last year, the UN General Assembly, His Highness the Emir of Qatar, Sheikh Tamim bin Hamad Al Thani, emphasized the need for joint action and international cooperation for addressing environmental, social, and economic challenges arising due to climate change, which impact all forms of life in both developed and developing countries alike. Qatar hosted the UN Climate Change Conference in 2012, which resulted in Doha amended to the Kyoto Protocol and signed Paris Agreement in 2015 to address the challenges of climate change. While climate change has emerged as the most material ESG issue, we at Qatar Stock Exchange believe that any climate change action, while climate change has emerged the most material ESG issue. We at Qatar Stock Exchange believe that any climate change action cannot be sustainable without addressing the social and governance issues attached to it. This is why in 2016, we launched the ESG reporting guidelines for our listed companies and have seen a global gradual adoption of ESG reporting in Qatar. At QSE, we are committed to advancing the ESG agenda for the benefits of all. Our aim is to become the investments destination of choice for ESG investors. To this end, we are encouraging rather than demanding that our listed companies consider to demonstrate their sustainability using the tools and guidance we have provided. We believe that companies will recognize and appreciate the resulted benefits from his level of engagements with their shareholders and prospective investors. I would like to give my personal thanks to all of the panelists who are giving their valuable time to be with us, and to all of you who are joining us this afternoon. I do hope you enjoyed the discussion. I will now hand you over to Mr. Rahman to deliver his presentation.
Thank you, Mr. Hussain. Welcome all to this webinar. First of all, I thank Qatar Stock Exchanges for organizing such an important topic and event, which is taking the investing world a little bit by, not surprised, but a lot is happening. So some of the investors are getting confused. What is environmental, social, and governance investing? Some have moved away from ESG into climate investing. So we're going to touch upon some aspect of that during this presentation. I hope all your family and friends are safe. Actually, about 2 years ago, we did a similar event in Doha, and we promised that we'll come back last year to hold a in-person event. But the world changed, so God willing, maybe next year, definitely we'll plan and do something, a bigger event in Doha under the aegis of Qatar Stock Exchange. But before I go into the explaining what is ESG and why it matters for investors, let me put out a manifesto or urgent call to action that MSCI proposed last year via a note that was published around January of last year. And there we actually laid out the principles, the best practices for integrating ESG into investment process, investment portfolios. And one of the things which we have been observing is that there is a seismic shift which is happening in the attitude of investors globally around this topic. And we have started to see an impact of that on the pricing of assets and asset valuation, and which is going to result in a big overall of the asset allocation process and reallocation of the capital. So if you are an investor who is sitting on the sideline thinking this ESG is a fad, nothing is going to happen, you probably will be taken by surprise when this large-scale reallocation of assets is going to take place. So this is a theme that we want to address in this presentation. Moving to the next slide, please. So here we want to lay out, as Mohsin pointed out, that there has been a lot of assets which are moving towards ESG-oriented ETF, also mutual funds, also we've seen large-scale institution making a call on ESG and climate. But one simple metric to measure is that if you look on this left side, we have pointed out the number of signatories to the UN-sponsored network of investors who are laying down these principles of best practices for ESG integration. This is called UNPRI, or Principles of Responsible Investment. And this organization was started way back in 2005 under the aegis of then Secretary General Kofi Annan. And in 2006, formally about 100 signatories came in. And today, if you look at the number of signatories in 2021, there are more than 4,000 investors or fiduciaries who have signed to the UNPRI. Collectively, they oversee 121 trillion US dollar. So this is a very sizable amount of money, which has been now under the fiduciary responsibility of people who are trying to integrate ESG into portfolio. And some of the metrics on ETFs, which we have seen, a tremendous growth of ETF, which are tracking ESG and climate indexes. So now question is why this is happening. So if we move to the next slide, please. We see that if you look at back in the day when large-scale corporate ESG incident happened, investors really didn't care. For example, when about 30 plus years ago, Exxon had a big oil spill in Alaskan shores, the stock price didn't even move. In fact, after a week of that incident, it rebounded and it had showed a positive performance. But now in the last maybe decade, we are seeing any major accounting scandal, a fraud in the corporate governance area, or a privacy and data issue breach, health and safety issue, have led to a large-scale event in the stock market, but that specifically that particular company, the stock price is impacted. For some of this, you are very familiar with, BP had a Deep Horizon oil spill happening in the Gulf of Mexico. You have, Equifax, there was a big data breach. Valiant was a pharmaceutical company, a huge accounting fraud. each of this event led to a massive decline in stock prices. So if you're an investor who's investing in large scale global companies, one of the things which will come up is that how resilient are this company? What is the corporate governance practices? What are the practices on environment and social aspect, which is going to protect any of this event-driven incident or the corporate ESG event-driven incident? Now, this is one aspect of it. But more importantly, if you go to the next slide, what historically, when people went into ESG, it started as a more of a values-based investing or socially responsible investing. And people thought that if you're doing good to the world, are you going to make money? Is there a premium for investing in ESG? So now more and more studies have started to show this financial linkage to ESG investing and the performance of companies. So on this left side of your chart, you can see that our research at MSCI proves that companies which are more resilient and more are highly rated on ESG characteristic are highly profitable. They also are less prone to systematic shock, or they're less prone to stock specific events. And this in turn lead to a large scale improvement in not only the valuation and also stock prices. For example, here we are showing the metric of the gross profitability of companies from lowest rated ESG quintile, the Q1, to the highest rated quintile, the Q5. Clearly, you see a large scale improvement in the overall profitability of companies which are very highly focused on improving their ESG ratings. Then the second aspect is, if you look at the right side, for the skeptics of saying that can ESG benchmark deliver return, if you look at just the performance of one of the oldest existing and live index on ESG is the MSCI KLD 400 social index. That index has done similar, in fact, slightly better than the MSCI USA cap-weighted benchmark. So this is over 30 plus years of this performance. So over 30 plus of years, if you have invested passively into a ESG oriented benchmark, you've not lost money. In fact, you have slightly gained money in terms of performance, but overall your risk is also low. The KLD 400 index has about 50-60 basis point of lower risk compared to the MSCI USA. So that's another aspect of people who are thinking, a skeptic saying that ESG cannot deliver returns. So if we move to the next slide, please. Question becomes, okay, we are talking about ESG and ESG performance, but actually what is ESG? How do you actually measure ESG? Is it something similar to credit rating? Is it you are reaching out to companies? Are you doing a survey and talking to the companies and asking them, are you doing socially good? In fact, the way the ESG approach is done at MSCI and other firms which are doing this similar exercise is that we look at broadly key issues which are dominant for that particular sector where the company is located. And these key issues are not similar to all the sector. For example, if you are an oil company, your key issue may be how to mitigate anything which is going to impact their performance because of climate change. If you are a utility company, probably you are looking at something more about water stress because you require a lot of water for your operation. If you are a financial company or a company which is providing services to consumers, then privacy and data breach may be more important, isn't it? So these key issues are very sector specific. So the environmental and social pillar, what we do is that we look at what are the dominant key issues which are relevant for that sector. Now, corporate governance is universal in nature because the practices of corporate governance can be applied across all the companies in different sectors. So when we look at the assessment of ESG, we identify what are the key issues which are dominant for that sector. Then on the basis of that, we look at the exposure of the companies which are in that specific industry to see how they are managing those key issues. What is the management doing? How large scale exposure you have to the key issue and what is the management of it? So related to the peers, if you're doing a good job within the sector, then you're going to be rated better than your peers. So it is an industry relative ranking or rating that we are doing. So at MSCI, we apply a 7-scale spectrum. AAA and AA are leaders. Then you have the average, anything like B or CCC are the laggards in the industry. Now, the next question is that, okay, that's great. You identify these key issues. How do you actually capture the exposure of the company to those key issues? Are you again reaching out to the company? Are the company providing the data? Because that's one challenge, isn't it? You can, if you look at large cap names or the companies which are global in nature, are probably providing a better corporate disclosure. So the question then becomes is that, will there be a size bias if I go to mid cap or small cap names, or is it maybe if I go to countries which are not that open to disclosing, what happens to their assessment of this company? So you'll be surprised that historically, maybe corporates have started to disclose a lot of information, but still about 50% of the exposure analysis that we do for the ESG is only coming from the corporate disclosure. We also use a lot of alternative data sources, which could be governmental agency databases or NGOs who are providing this information. We also reach out to media. Media is one which is collectively looking at what is happening in places, remote places. They're scrutinizing the policies, social policies. If something happening in Australia, a mining company blows up a cave, people are watching it and it's coming in global media. So that's another source. And finally, they are structured data, model data, or estimated data. So collectively, all this information using the technological advancements like machine learning and AI, that can also help us to kind of gather more information. But one thing is that as we go towards the alternative data or use technology to, definitely there can be noise in the data, isn't it? When you're trying to gather this information, how do you actually then remove the noise? That's where the specialization of human intelligence comes in. We have about more than 200 plus analysts who are actually scrutinizing all the data points that we have collected, these thousands of data points that we've collected. And finally, we make an assessment where the companies rank related to the peers within the industry. Moving on to the next slide, please. Let's take an example of a company like Coca-Cola. It's in the software and beverage sub-industry. And if you look at for this particular company like a Coca-Cola, what are the different issues? I said before that on the governance side, these key issues are similar to other companies globally. So it's about what on the corporate governance practices like the board, the pay, ownership, accounting. You're talking about tax transparency and business ethics, which is relevant for all the companies. But when it comes to environmental and social pillar, then you have to look at what are the key issues which are going to dominate a soft drink sub-industry. So definitely one is carbon footprint, because Coke is manufactured in the bottling agency and then it needs to be transported and bottled and transported to various locations. So it's going to increase the carbon footprint of the delivery of that product finally to the end consumer. You're talking about water stress is another key issue because you require a lot of clean water to create soft drink and a lot of sugar also. And you're talking that leads to this health and safety and nutritional aspect on the social pillar. So finally, there is also packaging material. How do you actually package it? How much of waste is generated? Can be recycled? Because you see that, if you look at in the olden days, used to be glass bottle. Now you used a lot of plastics is there. What will happen to that waste of plastic? How much of waste is generated because of delivery of Coke in PET bottles? So this is how we measure. Then we see what is the exposure to each of these key issue for Coca-Cola related to what is Pepsi is doing and other regional players who are doing on the sub-industry. And finally, based upon that exposure, we look at what is management doing. Are they moving to reduce their carbon footprint? Are they managing their water stress? Are they moving their product profile away from anything which is more less healthy to more healthy? So based upon that, a final assessment of Coke is done on the rating perspective. So maybe closer to home, let's look at a company which is based in Qatar and listed in QSA. And it's a gem of QSA. It's because we have been monitoring Qatar National Bank for some time, and we'll see that the progress they have made over the years. Clearly, this company is a leader in the ranking. It's AA rated. And if you look at on the next slide, you see that this company has made tremendous progress from the time we have been monitoring it. It was somewhere in the average category. It moved to a rating in August of 19 and 2020, and now you're talking about AA. It's leader in the. So it's a jewel crown of the Qatar Stock Exchange. If you look at globally, only 25% of companies are in the banking sector are AA rated. And if you look at among the industry peer, they even compared to some of the larger banks like JP Morgan or Wells Fargo, which are having tremendous issue, you're talking about QNB as a leader in terms of ranking. The question becomes, okay, why is this important? I said, okay, for a corporate, it is good that they can show it to the world that they're doing good. Maybe investors get excited, but why does actually it becomes relevant for investors or corporate entity who are in the webinar today? So that's why this integration of ESG into policy benchmarks is happening. So if you go to the next slide, please, we see that there are three different ways investors have started to approach ESG integration. So if you look at on the right side, the two more common ways which used to be in the past was what we call as values-based investing and impact investing. So if you look at most of the companies and corporate entities and investors in the Middle East, in the GCC, have some principle of Sharia compliance in their portfolio construction. So this is a what we call a belief-based or ethically conscious investing. That continues to grow, and we see that as a leg of ESG investing, but that's not the final ESG investing we are talking about. The other aspect of ESG investing is about impact investing. So you may be thinking about how to protect the environment. Can I create a cleaner technology portfolio? Can I mitigate some of the issues which can be happening about on social justice, women empowerment? So those are something about creating impact. So looking for companies which are making that impact and creating and allocating money to them. Now, these are what we call as more of individual objectives oriented portfolio, isn't it? Your values and impact. But investment objective is more on the left side, where financial integration, financial materiality is more important. And here is where the research shows that if you integrate ESG across the spectrum of investment process, there is a potential to generate alpha in the long run. So there's an opportunity to generate a large-scale return by integrating ESG. And that's where the move toward ESG is happening. Yes, values and impacts are important, but this whole-scale integration of ESG is where the industry is moving towards. If you look at the next slide on the benchmarking aspect, if you look at this is where how a global benchmark have started to align. So you see MSCI All Country World, which includes large and mid-cap companies globally. And then the ACWI IMI, which includes the small cap companies. So this is the traditional way of looking at market cap indexes. This is where most of the investors have been focused on. But what is happening now is that if we move to the next slide, please. We have started to see investors started to integrate ESG into this cap-weighted benchmark. So the one approach is doing a tilted approach. So you start to overweight companies which are best in class, the AAA companies, and remove companies which are CCC or have severe controversies. So that's a tilted approach. There can be other approaches like ESG leaders, where you create only companies which are above average, BB and above. So these are what we call the best in class within each of the sectors where they operate. Or you can go extreme. We are looking at even the extreme cases are only I'm looking not above average, but the true leaders in the industry, what we call as SRI indexes. And then also the investors, some of the investors believe that if I do it this large scale shift away from a policy benchmark, what's going to be the implication of my tracking error? And that's why there's more optimized ESG focused kind of benchmarks have come in. So let me summarize here. ESG investing is not a fad. It has been going on for last many multi-decades. It's not a concept which is just coming out of the blue. It's a concept where investors, long-term investors, later on we will hear from QIA and others, we see long-term investors have started to focus on ESG and climate. And we'll see that these two dimensions, ESG and climate change, are going to take a major shift in the way assets are going to get reallocated. So if you're a corporate who are listening into this webinar today, if you are not moving your policies and aligning with the way the investors are thinking, the way the climate change is going to impact your companies and how you're going to mitigate that thing, the move toward net zero, that is going to have a large scale reallocation issue when the move happens. The cost of capital of the companies will go up, the profitability may be impacted, your consumers may move out of the spectrum. And it's not a Qatar only issue, it's a global issue. As this capital get relocated, investors go globally hunting for alpha, they're going to not only look for companies which are financially sound, but also ESG sound. So let me pause and hand it back to Moshe to continue the program today.
Thank you, Raman. That was really very insightful, and I'm sure we will be diving a bit more into this when we have the panel discussion. Now, I would like to invite Stephen Fisher from BlackRock to hear from him how BlackRock is integrating ESG into their investment practices. Stephen.
Sure, thank you, Mohsin, and thank you very much to the Qatar Stock Exchange for inviting BlackRock today. I really enjoyed the previous presentation. I thought it was a really good way to level set around what is a very, very important issue. My role within BlackRock is in the Global Public Policy Group. So what keeps me awake at night is mainly around sort of regulation and policy. So in my remarks, I may sort of pivot towards that broader global discussion, but very, very happy, of course, to cover the why and the how of how we're integrating ESG into our investment process. But before I do, I just wanted to offer a few sort of headline thoughts, a preamble, if you like. And we talk generally about ESG, but we need to recognize that really this started with the E. This started with the environmental side and on climate science. And I think it's fair to say, you know, once you've seen the data on climate science, you can't unsee it. Here in the UK, where I'm based, there is now a clock which basically tracks the amount of carbon being emitted every second into the atmosphere. And it tracks the amount of time we have left until the global rise in temperature reaches that 1.5 degrees. And it's a very striking image. It's similar to the debt clock you see in New York. And so once you've actually tried to understand what that actually means in practice, in terms of the way we live, not just in terms of how we invest, it's very, very difficult to come back from that. So climate change, I think, you know, is a generally accepted issue of our lifetime, and certainly for our children's generation as well. Climate change has historically been understood as a problem for governments. It was seen up until very recently as a collective action problem. It's for them to solve, and we'll just carry on in industry doing what we do until someone tells us to change. But we've actually learned that action by governments is not enough. And in recent years, just in the last sort of 18 months, 12 months, that shift has focused the shift has been quite dramatic to what corporates can actually do to bring about meaningful change on climate. But I think we all must now think about how the global economy actually works if we want to decarbonize that economy. So we need to think through what is the impact of agriculture, what is the impact of cooling our homes and offices, or in my case in the UK, heating my home and my office. What is the impact on power generation, on shipping, and on aviation? We need to start thinking about the how rather than the why of climate science. And we need to harness market forces, because the global economy does not divide neatly into different jurisdictions or into different countries. I think from a policy perspective, we need to think and act about the global economy we're trying to decarbonize. So think about it in terms of supply chains, think about it in terms of connected linkages across borders. The positive power of markets, it must catalyze change. The business model and the technology is there to make it possible. So although sometimes the picture does look very bleak, we haven't yet fully activated these forces for good through markets. And what we did as a firm earlier this year, under the leadership of my CEO and chairman, Larry Fink, we issued a commitment to net zero. And I'll just walk you through the why we did this, and I'll walk you through a little bit of the how we're going to achieve this. So first of all, why? Why is BlackRock talking about ESG in almost every conversation we have with clients in any part of the world right now? Well, first and foremost, climate risk, we believe strongly, is investment risk. So this is not about values, it is about value. This is not about what we believe or what we hold out to be an abstract principle. This is about hard financial risk. And our responsibility is to help clients navigate this change because it impacts everything we do, from managing portfolios to building products to engaging with other companies. The second point, the second pillar, if you like, of the why is the net zero economy is arriving and it's speeding up. It's arriving in real time. And we believe this is a historic opportunity to invest in climate innovation. And we believe that companies who evolve will be rewarded by financial markets over the longer term. And then finally, we're cognizant of our responsibility towards people and the planet. As the world's largest asset manager by AUM, we have a responsibility beyond managing portfolios. And we are committed to reducing environmental damage while boosting innovation, which enables us to build a more just and inclusive world, and one where more and more people can prosper. And if you like, this takes us closer to the S of ESG, and I'll come on to what that means in just a second. So how are we doing this? How do we advance sustainability at BlackRock? So there is no one silver bullet. There's no one answer. It's a toolkit. It's a range of measures that we can deploy. But essentially, it is centered on developing expert research and insights and data. So the presentation that Raman just gave you, I thought was very, very insightful. And it's exactly that level of quantitative analysis that we need in the marketplace to stimulate the conversation about ESG and to start thinking about climate risk as investment risk. One example is we have launched climate-aware asset class return expectations. So most forecasters currently ignore the effects of climate change in their economic projections or long-term return expectations. But we don't believe this is right, and we don't believe this is sustainable in the longer term. Our return expectations, the building blocks of our strategic asset allocation, now reflect the impact of climate change on the investing landscape. And this is an integral part of a series of actions that BlackRock is taking to prepare for a net zero world. We also see the transition to a more sustainable world helping growth and presenting an historic investment opportunity. So, traditionally the conversation around ESG has been around managing downside risk, but actually we're seeing it in terms of upside opportunity because the transition is now, and what we're trying to do is capture the value of that transition on behalf of our clients. Another element to the toolkit is how we access sustainable solutions through products and technology. And Mohsin, at the start of this webinar, threw out some numbers in terms of just underlining how important ESG investing is in quantitative terms. Well, last year, we launched 93 sustainable solutions, mainly exchange-traded funds. And just last year, that led to 39 billion of allocations. And this was in a year when there was a global pandemic, when people were highly distracted about just basic human survival. And then, of course, we saw the sort of rally towards the end of the year. So in an abnormal year, we attracted 39 billion of allocation, and I'd expect the figure for this year to be many multiples of that. Through our technology platform, which we call Aladdin, clients can quantify climate risk in financial terms, and they can take action as well. And one of the things we're trying to get to is to have the data which will effectively allow us to quantify investments, quantify portfolios in a degrees Celsius number. So just as you would have an expected investment return, what we are aiming to do is also provide you with a number which shows how your portfolio is contributing to climate change as well. So if you're not happy with a portfolio which generates +3 degrees impact on the overall climate, then of course you can adjust that portfolio, but at least you have the data. And so we are not prescribing one way to go or another, we're simply providing the tools and the products through our technology to enable that decision-making process. Another element to the toolkit is through engagement with other companies. So through our stewardship and corporate governance activities, we are establishing robust engagement priorities. And we're engaging companies on sustainability and governance priorities. and we're reporting back to the market in very visible terms on our stewardship priorities. Being a significant index investor and working with companies such as MSCI, we don't have the tools to effectively disqualify companies or divest from companies if they're in the index. If they're in the index, they're in the index, and we can do very little about that. So what we have to do is engage in a long-term discussion, because we're long-term investors, around the priorities for different companies across a whole range of metrics, but especially now including ESG. What is the environmental impact, as was explained very, very clearly by Mr. Rahman in terms of how you measure that? What is the social impact of this company? How do you actually judge the social impact of the company? How is this company in terms of corporate governance, for example? And then we'll report back to that to the market. And then finally, we are committing to ESG through our own business and through our own people. So we have to walk the walk here. We have to do as we say, and it's not sufficient just really to tell other companies what to do. So what we're doing as of last year is providing transparency into our own operations and reporting under SASB standards, so the Sustainable Accounting Standards Board standards. We're actually showing other companies what it is that we're doing. And we're by no means perfect. We have a journey to go on, but we're taking steps and we're willing to be monitored and assessed by other companies as a publicly listed company. And what I spend a lot of time on in the policy team is really trying to engage with policymakers to establish a common language for sustainable investing to support global policy initiatives. And maybe in the discussion, we can come on to a few of the themes around regulation and policy and some of the tension points globally, because we strongly believe that we need, just as I mentioned at the start, we are not talking about countries dividing up neatly and devising their own standards for their own industries. There needs to be, at a very minimum, a dialogue between countries, and even better, globally agreed common standards. So we have a global metric to measure ESG, because essentially this is a global problem and it requires global solutions. So in the interests of time and moving to the discussion, I'll leave it there just by way of high-level introduction, but very happy to handle any questions in the Q&A, and I look forward to the discussion that's forthcoming. Thank you.
Thank you, Stephen. And Raman, both, I think you have shared interesting insights in terms of how MSCI is benchmarking and various companies in your universe. I believe overall there are about 8,000 companies that you look at globally, or even more. And Stephen, I think it's also interesting to see how committed BlackRock, is one of the largest investors in the world, is managing public money and client money also to that you're integrating ESG into your investment process. Before we move to the panel discussion, I wanted to also thank the Qatar Stock Exchange's ESG committee for their role in encouraging the listed companies for publishing their sustainability reports and reporting their ESG credentials as per the QSE guidelines, which Hussein mentioned earlier, were published in 2016. It's a work in progress, and we continue to engage with a lot of listed companies. And today's webinar is part of that, that engagement. We would like to encourage companies to report more and more and be more transparent about their ESG credentials. We are partnering with MSCI to understand better how ESG ratings work, so that we can in turn reach out to our listed companies and help them improve their ESG ratings. We will be rolling out a ESG data product for our members and for the listed companies in Qatar, so that it will help them not only know how they are being rated, but also how they can improve their ESG ratings. I would like to start with, and I think a lot of the audience has been waiting for Ahmed Al-Hamadi to come online. I would like to start with Ahmed on the panel discussion. and we will introduce other panelists as I point towards them. Ahmed, QIA is a signatory of One Planet Sovereign Wealth Fund initiative. And your CEO in June this year announced that QIA is in the process of integrating ESG into their investment process. Could you elaborate a little bit further in terms of how QIA is integrating ESG into their investment process?
Yeah, thank you, Mahsen. I mean, I think the introduction that you've given is quite accurate. From our perspective, we're a signatory to One Planet, and we were a founding member actually since the end of 2017. And that was really sort of, I'd say, the first point that we started on this journey. But let me sort of take a step back and talk a bit more about the role that QIA plays within the country. So we're mandated as fiduciaries to sort of creating long-term value for both the state and future generations. And now what that basically means is sustainable investing has to be part of what we do. And that sustainable investing encompasses several things, whether it's ESG or higher returns or any mandates in terms of the concern with the development, whether locally or internationally. And as such, ESG fits quite uniquely within what I would say the mission and the vision of QIA is. 2 years ago, our CEO also noted that we will no longer be making new investments within hydrocarbons, both from an ESG perspective, both also from a long-term sustainability perspective. As you correctly mentioned earlier this year, he spoke about how we're going to start integrating ESG within our investment process. This has been a continuous process that we started many years ago, but I think formalizing it today is extremely important. And we've had various discussions with some of the members that we have on this panel and others, whether through One Planet or through our contacts based on that discussion. So it becomes extremely important for us as we think about sustainable investing and understanding where the performance or outperformance would come from in the future. I draw on sort of the example that many people can think about if investing maybe 10 years ago into VC investments in technology. VC at that point in time was not really a great asset if you looked at historical returns, but if you looked at sort of what you expect the sector would do, it was a perfect time to invest. We view ESG could be that, investing could be part of that. It's no longer sufficient to say we're going to allocate capital to ESG. We believe this is part and parcel of the overall investment process. So everything that we do should have that ESG impact, the same way that we run our sort of sensitivity analysis of various risks of geopolitical or currency fluctuations or any other type of risk. ESG sort of angles, whether it's governance and so on and so forth, should have an effect in terms of how we make our decisions. I think Rahman earlier showed us long-term returns of the normal index of ESG and how they performed or outperformed. I take a similar view, but also slightly different. I think companies that score high on ESG are high-quality companies. And I think regardless of whether it exists in ESG or not, we all want to be investing in high-quality companies. And right now, we're seeing all those high-quality companies taking care of those ESG mandates. Governance becomes a huge part of it. Social responsibility becomes a huge part of it. And now maybe for the last, I'd say, 2 years, not even environment totally, but climate has become a very important part that everyone is very much focused on. And I'd say rightly so. So those are, I'd say, are the general headlines through which we look at the investment landscape from a perspective of ESG. To sum it up, it's part and parcel of being sustainable, ensuring higher returns in the long term.
Thank you. So I would like to move on to Akbar, who's also an investor, but manages private money with Al Rayyan Investment. Has been with us in Qatar for more than a decade now. He has a flagship GCC fund that invests in the whole GCC region, with the exposure of about Qatar exposure is about 21% there, and also has a dedicated ETF on the Qatari market. He's by definition a Sharia compliant investor. Akbar, with that introduction, how do you see the advent of ESG investing impacting your business? And are there any similarities or synergies between Sharia-based investing and ESG that you see, especially in the context of this region?
Thanks, Mohsin, and thanks for having me here. Look, all investors, whether it's Stephen or Ahmed or ourselves in Al Rayan, the G part of ESG has been something that we've all looked at for a long, long time. That was traditionally how an active asset manager made investment decisions by really focusing on the governance and various parts of governance and how companies are managed. So that's effective. That was always there. As you rightly mentioned, Al Rayan Investment is a subsidiary of an Islamic bank. So everything that we do is Sharia compliant, and we invest in both equities and in fixed income. So we invest in Sukuk. So there is, ethical investing is in using the terminology that Rahman mentioned is, exclusionary by nature. So we exclude certain companies within our screening process, within our universe. But Sharia investing, particularly on the equity side, is essentially formalizing a risk management framework. So a non-Sharia compliant company doesn't meet certain balance sheet ratios, which would be deemed to be make them higher risk. Not so it doesn't eliminate risk. It just means that they're higher risk, and therefore they are outside of our universe. And Sharia compliant Islamic indices significantly outperform conventional indices in Qatar, in the Gulf, even in many cases outside as well. So it comes back to the point of, if you are looking at companies which, from a Sharia compliant point of view, in our view, are have ethical considerations, are part of what we would call a formalized risk management framework, then you do end up over the medium term with significant outperformance. So from our perspective, the advent of ESG globally and the greater focus on ESG in the last couple of years ties in extremely nicely with what we're doing, and actually, to be honest, has made it easier for us to explain to people why we do the sort of things that we do. 10 years ago, 15 years ago, when we were having these same conversations, investors who are not Sharia sensitive would be slightly puzzled that we would go through this sort of screening methodology. Now it's pretty standard to screen, and the numbers for the growth of ESG speak for themselves. And as Ahmed just mentioned, if you do have a medium term, or in QIA's case, an extremely long term perspective, that's what drives returns. So it suited us very nicely. But I would add, though, that in our region, our client base is largely institutional, some individual as well. To be honest, and this is probably almost certainly a function of where we live and where the income comes from, E is not such a big focus for our investor base. The S and the G certainly is.
Okay, I think we'll pick up on this again, but I think even where we live, I think generally E is equal to C, or carbon footprint, and that's why people are less concerned about it. But I think one key element of the environment is water as well, and clearly we live in a desert where water can be a scarce resource and could be a climate risk if things were to go wrong. So I think investors do need to pay attention to environmental risks as well, perhaps not associated with hydrocarbons, but associated with hydrogen and oxygen. Leo, QNB. Raman gave an example of QNB. Clearly, you guys are the superstars in Qatar when it comes to ESG reporting and ratings. Compared to regional banks also, you have one of the highest ratings in the region. Could you share the journey that QNB has gone through? At what point it became important for QNB to focus on ESG reporting primarily? Because you could be doing all sorts of things that you're doing, but why was reporting that important?
Thank you, Mohsin, and a pleasure to be with you and to speak with everyone here today. And certainly, thank you for highlighting our rating. Is something that we're very proud of. At QNB, we've long held the conviction that banking is more than simply being a financial intermediary, and we've seen that sustainability or ESG is not just a trend, of course, and is a strategic imperative, and it's something that can add value to our organization and to wider society. So, to that end, we started our sustainability journey around 4 to 5 years ago, first by establishing a dedicated sustainability team within the group strategy function. So we are kind of a core part of the overall group strategy. We've established our sustainability framework, our policy and our roadmap. And that helped us to be very well positioned to respond to investor and market demands, especially in more recent times as the topic has become increasingly prominent. Now, we've already seen that for the investor community, this is a very important topic. But over the recent years, and one of the reasons why we've started our journey in advance is that we see it as a priority topic for our customers, for regulators, for rating agencies, governments, our own employees and society as a whole. And therefore, if it is on their agenda, it also must be on the agenda for us and for other corporates as well. Now, in terms of why it's important for us, I completely agree with what Ahmed, Akbar, Rahman, and Stephen said around capital reallocation, consumer sentiment, and delivering impact. Absolutely. I will add a couple more things. As an organization, let's be clear, we see that ESG topics touch every part of an organization. Every division of our business, without exception, is impacted by or can impact sustainability. Thus, it was key for us to ensure that we have an awareness across the institution. We have key initiatives, we have increasingly capabilities in place, and we are able to embed a culture of sustainability across our entire value chain. Now, that's from the suppliers that we work with to our own operations to our customers and how we do business. And I think finally, the reason why we've embarked on this journey is moreover, as a key participant in the economy and in society, it's simply the right thing to do.
Great. I think, and I would like to commend, I think that over the period of time, as Raman was also showing on the chart, that QNB has consistently continued to grow its rating. You are one short of AAA, and I hope we will work together to get to that AAA as well. I'm sorry, I am greedy and pushy. I think, and you can be the showcase for Qatar to how to get to AAA. Stephen, I think I want to come back to you with regards to, I think you have heard how important it is for QIA or even for Akbar in Al Rayyan Investment, both sovereign wealth fund or public fund manager, and QNB as a local corporate. But again, I think, and there was a question in the by one of the participants about the reporting requirements becoming mandatory. So these are some of the policy debates, obviously, we are having at the regulatory level. Given your background and your global discussions with global policymakers, what would you advise Qatari regulators or participants in terms of how to address these policy level challenges?
Yeah, thanks, Mohsin. Great question. Not easy, I think, is the short answer. But there are a number of different themes here we can talk about within a broader debate. And many of these themes become intertwined and often conflated or mixed up. But let's start with issuer reporting. which I think is probably the most important policy issues to be solved in the sustainable space. So promoting better and more standardized ESG stroke sustainability related disclosure by companies is a priority. You could ask yourself, well, why? For what purpose? For which audience? And these are questions to be really defined. I think, as was mentioned just now by Leo, I mean, I think, ESG touches every part of every business, or at least it should do, or at least it will do in the future. And I think real leaders in different sectors would want to promote what they're doing in ESG and be held out to that higher standard. So I think the point around what I raised before about measurability on a global level, that's really key here. So issue reporting, globally agreed standards, I think we make advances in ESG by really doubling down on that. We can also look at product standards as well. And this is a big debate actually in Europe right now. And it's interesting because a number of the regulators in Europe are really becoming quite forceful about this. And there are a number of enforcement cases, both in Germany and potentially elsewhere in Europe, around enforcing product standards around ESG. So the principal drivers of the debate around the need to address greenwashing. So by that, what I mean is, if you are marketing a product which is meant to be green or ESG compliant, you better make sure that it is. And it isn't just a convenient marketing label for this. And I think as we're in these very early stages of ESG investing, I think there will be many more instances of greenwashing cases brought forward just to establish what is truly green and how we measure that, as opposed to what is just purely a marketing sort of slogan, if you like. So, I think greenwashing covers product naming, it covers classification, it covers product and portfolio level disclosures. So that product standards and greenwashing, that's a big theme in the European markets, where we've been talking about ESG really for about sort of 5 to 7 years with reasonable seriousness. The other element I'd mention from a policy perspective are the global climate frameworks and the high-level politics of country-specific emission reduction plans, industrial infrastructure decarbonisation strategies, as well as the need to mobilise public and private capital investment in new climate-positive projects to meet these objectives as well. Each country does this slightly differently, and I think that's absolutely right and normal. But again, we need to understand as an investor, what is the pipeline of these projects coming forward, and where is not just the investment opportunity, but where is the sort of ESG opportunity? And the stronger the correlation between the two, then the more compelling investment it would create. One of the things when I traveled to the region, obviously pre-pandemic, was it just struck me what an opportunity there is in the Gulf region to think about a climate framework from a regional perspective. I've talked about the importance of global standards, product standards, issue reporting standards, but equally, I think there is a space, particularly where an established developed jurisdiction such as Qatar can play, is really to think about how you incentivize those companies which are on this transition from decarbonisation to ESG as well, and how you actually articulate that so that the value in the transition is actually captured by global investors. So I think the global investment framework is the third important pillar. And then finally, for geopolitics, and I've just alluded to this, but really, we're thinking about which countries and regions are seen to lead the debate. Where can regulatory frameworks create economic opportunities and regional advantages? And set this against the backdrop of political retreat of globalization and the rethinking of global supply chains. So we're in an unprecedented sort of point of realignment, in my view, coming out of the pandemic, with the rise of China, with the volatility, political volatility we've seen in the US, with Europe, sort of trying to find its place in the world between these two poles. There's a lot of political friction right now. And I think what we're seeing here in Europe, particularly on the EU side, is Europe trying to distinguish itself to say one of the core characteristics of the European capitalist model is this notion of leading the debate on sustainability, and the characteristics of European capitalism is around being sustainable capitalism, and they're trying to assert and trying to put down high standards soonest so that the rest of the world coalesces around that. So very, very interesting sort of chase of capital going on right now, all around sustainability standards. So that's a huge amount of sort of intertwined, complex ideas there. But I think, from a policy perspective, issuer reporting, number one, product standards getting quite serious now in Europe, at least. Number two, how you actually invest in green, how you actually measure that's really, really important. The global climate frameworks are important. And then set against that is this backdrop of a changing geopolitical situation.
So you mentioned obviously pandemic, and I want to switch to Raman. He's been listening to all of us very patiently after delivering that keynote. Raman, I mean, over the last year and a half since the pandemic was declared by WHO, I'm sure client attitudes have evolved towards ESG. Could you give us some insights into which component of E, S, or G has gained some more relevance or prominence in your discussions with the customers? And so I think that will help us understand how companies should be addressing different issues in their reporting as well.
Thank you, Mohsin. I think let me start by giving some of the newer research which we have done, and also what others have done shows. If you look at the three different pillars, we have the E pillar, S pillar, and G pillar. Definitely, as Akbar pointed out, G was always looked up. All fundamental managers, active portfolio managers always thought G is the more prominent one. But if you look at the key issues which are driving the G pillar, are more around what we call as event-driven risk. Short-term shock, which can immediately impact the stock prices. Whereas if you look at the E and S pillar, are more what we call as erosion risk. These are risks which can play out in the long term. So going back to what Stefan started with, the E pillar has taken a very dominant aspect in the last 2 years. The E from the angle of climate change. But if you look at E, it's not just, as Mohsin, you pointed out, it's not just exposure to carbon intensity. It has a lot of other additional aspect of it. So in the last year plus that we have been talking to investors, and the COP26 coming up in November, many of the larger asset owners and institutions have started to think about how can I be aligned to this One Planet initiative, which QIA has been part of. So that's where we think that collectively investors have to take a larger view set, because climate change and climate science clearly shows that it's the existential crisis for the humankind. So if that's the case, investors saying that, okay, I understand it's going to play out maybe 50 years from now, and maybe I won't be there, but it is for the future generation. And if you're a long-term investor, future is more key for you than what is happening today, isn't it? So that's why we have seen a larger impetus and push towards climate change mitigation. And to support that aspect, we at MSCI and others have started to provide some framework of how to think about climate investing. What are the benchmark? How do you create it? So going back to the region, if you look at region, it's exposed to hydrocarbon. You cannot just go to a large-scale economy which is based upon revenues from hydrocarbon and say that you have to decarbonize on the day one. So there is a pathway that depends upon the region where you are, and definitely it's the collective action. There should be, I'm pretty sure that there can be free riders out there, but as humankind, we have to go back and control that thing. So I'll say that E has taken a little bit more of prominence, but S and G are not far behind. I think when we talk about ESG, you have to think about a collective framework, and climate change is coming out as a separate entity, which is probably going to shape up how investors are going to think about long-term investing. But E and S and G are collectively as part of how we think about investing in general.
So E has taken the lead, obviously, given the climate issues. Closer to home, Leo, obviously, pandemic has impacted the country, and then a lot of corporates had to come up with a strategy to deal with it. How has the COVID-19 impacted your ESG strategy?
Thank you. Well, actually, interestingly, COVID has not really impacted our ESG strategy. Let me elaborate as to why. Our strategy is around delivering sustainable financial performance through identifying new business opportunities, mitigating risk, and strengthening the brand. And this is underpinned by some key pillars in our framework, in our sustainability framework. One is sustainable financing. This is how and who we do business with, and it includes things around climate impact. And secondly is around sustainable operations, our own impact of our footprint, and our responsibilities as a responsible employer of choice. And thirdly, beyond banking, which is our community investment and our CSR activities. Now, as you can imagine, COVID-19, despite the external shock, despite the impact, has not changed our framework nor our commitments. We stick to these, and that's, I think, a testament to the applicability and resilience of our sustainability strategy that we have in place. Now, I'd say one of the positives from this terrible event has been that it is a catalyst to accelerate sustainability initiatives. And as Raman said, with climate change, it has increased the market attention on both the E and S side of things, where historically it has been indeed on governance. Now, as an example, one of the things that QNB was required to do was to rapidly adjust our business and operating model to respond to lockdown measures, to social distancing, to changes in customer behavior. And that has allowed us to leapfrog, for example, our digital agenda to ensure that we could maintain our operations and at the same time maintain access to products, services, and financing to all our customers, whether they're retail, SME businesses, or corporates. And in fact, we found that in 2020, almost 70% of all our transactions were through digital channels. And we were able to offer the same safe and secure, flexible ways of working for our people. So in summary, our sustainability strategy remains, and it has been catalyzed by COVID-19.
So, I mean, I think with talking about E, S, and G, and I would like to hold on to you for a bit, Leo. I mean, the S part, I think, given Qatar is hosting the World Cup next year, labor reforms have been a big point in the reform agenda of the country. And I believe QNB also has played a significant role there with the wage protection system that has been introduced in the country for the labor. Would you like to touch a little bit on that also?
Yes, absolutely. So yes, this is a key case study of ours that we've reported on for a couple of years. So we have partnered together with Rido to deliver our mobile wallet system as part of the wage protection system as well, which has enabled workers to be paid on time, for the payment to be transparent and clear. And that's something that we're very supportive of and continue to drive as we deliver our sustainability agenda. I mean, on the S part, I mentioned before that we also look at how we engage with our suppliers. So one of the things we've done over the past couple of years is to look at our third-party risk management approach. We engage with our suppliers to ensure that they're compliant with all local labor laws and regulations. We have taken some of the recommendations from the Supreme Committee, and we've embedded that as part of our engagement with our suppliers as well. We've only just recently published our supplier code of conduct, which lays out very clearly what we expect from our suppliers in terms of how they operate, how they treat their workers, and equally what our suppliers can expect from us as well.
Sure. I would like to move to Ahmed. I think you've heard how ESG is becoming more relevant for benchmarking and for the Qatari corporates to step up their game. So, and Raman did mention, Stephen mentioned the concept around incentivizing, but also at the same time, from a policy level, perhaps having some instruments to almost like have a carrot and stick sort of approach. So you, being the largest shareholder in the country, can have both effectively. You can have a carrot also and a stick also. So what approach are you taking to drive this ESG agenda in the local listed companies?
Thanks, Mahmoud. I mean, as an institution, obviously, looking at that falls under the umbrella of the overall ESG strategies that we're setting for QIA, right? So we have obviously our international investments, and we also have our local investments. And there's currently a sort of a strategy being drawn out by both the CEO and the CIO responsible for Qatar on basically what would be expected. Again, the role that we play there is from a governance standpoint. Being like you correctly said, a shareholder in several companies within the exchange, there will be something that will be produced by the CEO and CIO of Qatar on that parameter. I myself, I'm the CIO in Europe, so let me just add a few more points in terms of how we do this within our European portfolio that I can speak to directly. It's something that we know before even sort of engaging with a lot of these companies. What we start off with is looking at what you have and assessing where you stand. And I'll use the example, for example, on power generation. 2 years ago, we looked at the portfolio and we found that around 40% of what we have in terms of power generation has zero emissions. The rest is generally a combination of mostly gas-powered utilities, which would then take the total to over 85%. So we take stock of both. I think, we're a strong supporter, obviously, of the utilization of LNG and gas externally. But we also sort of take into account other metrics in assessing how we're doing. And over the past, I'd say, less than 24 months since we calculated our exposure, we've seen our zero emissions go up from 40% to become 45% renewable. And if you take zero emissions in total, being 50% of the overall power generation portfolio. And that really is sort of a discussion with the existing portfolio companies that we have, understanding where the opportunities are, and quite frankly, acting as a catalyst for change. Within the infrastructure portfolio that we're sort of using the example on today, I think many investors sort of shy away, for example, of looking at coal investments. We see that as an opportunity, but our investments come with sort of stipulations in terms of transitioning that company outside or out of coal into renewable, and hence being a catalyst for change to the better, rather simply sort of stating out that we're not going to expose ourselves to that. And the reason we look at it from that perspective is in many countries of the world, especially in the emerging markets, and even in some developed countries, you can't expect countries, and I think, Roman mentioned that, you can't expect countries to suddenly turn off their electricity grid because a utilities uses coal power. The electricity needs to continue running to the various cities. But in the meantime, you have plans when you're refurbishing, when you're changing, is to input that capital into sort of moving into renewables. And you can use this exact sort of parallel across different sectors, whether it's in the industrial environment, or any other sort of parallel, I think, or sector that we look at and we invest in. So that's the general sense that we look at it from a shareholder perspective, using it, becoming a change, a catalyst for change, rather than simply saying these are the companies that we'll invest in, or these are the companies that we won't invest in, and hope that someone else comes and helps them out in sort of moving into the transition.
So I think, to summarize, I think ESG is very much in the DNA of QIA, and it seems that, as you mentioned, that the CEO and the relevant people are looking at how that can be implemented in Qatar, but the know-how and the expertise is already there in the QIA of how it's being implemented in Europe or in the US. I think it's a matter of time that the focus shifts to Qatar also, and local corporates will have to perform in terms of their reporting for ESG.
Yeah, I mean, first of all, I have to say I have to commend you and the rest of the Qatar Exchange team in terms of the steps that you've taken in bringing this to light and making this focus, working with MSCI on some of the indices that you're looking to come up with. I think that's something that companies, regardless of where they are, and specifically here we're discussing on Qatar, should take into account. These are important for us as an economy. I think ensuring that we're proud to see our companies with high ratings. So, QMB was a great example today. But we'd love to see all our companies having similar ratings. And quite frankly, we'd push them to have AAA ratings, and why just stick to sort of where they are. So it's a process, it's a journey, and I think we're all in it together, both in Qatar and globally. And hopefully, I think it's all to a common good that we all share.
Mm. Yeah. So, Akbar, I think you mentioned in your previous remark that your clients are more focused on governance. But if you were to wear a hat of an active investor, and you have been a great supporter of Qatar Stock Exchange in the Qatari market to push the agenda on investor relations that our listings team has been pushing over the last decade or so. On this ESG journey, how do you see yourself pushing the agenda to your clients with regards to the E, S, and G both? How do you see yourself playing the role? Would you be allocating part of your portfolio to ESG?
It's a great question, and it's one that we've discussed ourselves as well. Ultimately, we manage money on behalf of other people. The majority of the money that we manage is institutional, as I mentioned, and it's based on, for the most part, segregated portfolios where we get mandated by the investor who determines what they're going to do. So, from our perspective, while the S and the G are certainly areas that we, as I mentioned, are the focus, the E is less so. We expect a few things will happen. Firstly, we hope that as some of the policy changes from the big shareholders in the country, some of the sovereign-related shareholders, there's three really very large sovereign shareholders that own a lot of the listed companies, are majority shareholders of a lot of the listed companies. So we hope that as some of the policy initiatives start to trickle through, you start getting a lot better disclosure, so you actually know where you stand. So we can start telling investors exactly. I love what Stephen said, that they can tell an investor how much temperature change their portfolio is likely to drive. We'd love to just tell investors what the average ESG score is for their portfolio. And once we're able, it's a standard thing. Once you're able to measure, then you can start to improve. And so we would probably then want to have investors go down that conversation of saying, look, this is where we currently stand. This is where we would like to go, but we need your support because ultimately we manage your money. We also believe that in the E aspect is important, and Qatar is the largest exporter of the transition fossil fuel. The carbon emissions of gas are 40% lower than they are for coal. So we don't in Qatar, even in the region, frankly, because we invest regionally, no one is producing coal. So at least we're not trying to avoid that, but we can certainly focus on companies in Qatar and outside as well, which have better or reduced the impact on the environment, or which are actively creating products to help the environment. So it has to be a collaborative process. It's not our money that we manage, but we can certainly help drive that conversation with our investors. We've worked for many years, as you mentioned, with where we try to support you where we can with the initiatives that the exchange has had, particularly with the traditional areas of disclosure, transparency, investor communication with many of the listed companies. We'd love to broaden those conversations to add some of the other factors. So it's a journey, and we're in the early stages of it.
Thank you. And I think I'm conscious of time, so we just have one more question for Stephen. But before that, I want to raise my hand and promise that the next ESG panel, webinar, discussion that we will have, whenever we have it, we will make sure that there are at least 2 women on the panel or on part of the discussion. And the reason I say that is I think I want to pose a question to Stephen. Larry Fink, your CEO, is on record that BlackRock will stop investing in companies that do not have gender diversity on their boards. I think he mentioned that maybe around at least 2 women on the board is what has been published in the newspapers. Why is gender diversity at the board level so important for BlackRock?
Yeah, it's a really good question. I think it's important generally, and I think this is the less developed part of the science. So we're talking about the S within ESG as compared with the E of climate, where we've really focused the conversation today. But what we have seen is where there is a greater diversity of leadership, not just in terms of gender, but in terms of background, perspective, the ability to challenge, the democracy within the boardroom, we see a higher correlation between that and robust financial performance. And so I think, although Larry has clearly stated an aim towards having gender diversity as a target, I'll go back to my previous comment earlier in terms of we are a large index investor, and I'm just looking at the questions that have come in from the participants here today, and one of the questions was, do we have the power to really divest from a company? Do we have the power to sort of leave a company? Well, we certainly have the power to vote against companies and vote against their proposals at annual general meetings, particularly when we have an active stake in those. But we don't tend to sort of divest. We don't tend to, if you like, drop companies. We much prefer to have an investment stewardship approach, which is a longer term approach as a steward of capital. And this is particularly important for index investing, whereby we're locked into an index and we have to work with these companies to make incremental benefits over time. And within that, there are robust conversations around gender diversity and diversity more generally. But to your answer, why is this so important? There is now a correlation between, diversity of thought, diversity of gender, diversity of background, and outperformance. So it's one other thing to mention, one other thing to take into account in the investment process. Final comment, that has a caveat. It's much more difficult to measure than the climate piece, which now has objective metrics around it. So it's important, but there isn't a unified standard in terms of measuring that correlation between the two.
All right. Well, I think with that, there are many questions that we have received, and some of them have been answered during the discussion, but some, if we haven't answered, we will send the questions to the panelists and revert back to you with the answers offline. And I want to thank all the panelists who have joined us today. We would now move to the next segment, which is the opinion poll or survey poll from the audience, which will help us understand how they view the market and the ESG element in the context of the Qatari market, and it will help us understand how we need to further shape the direction of the discussion on this topic. Can we launch the survey poll, please? Yeah. You would see it on your screens. You can start responding by choosing one of the answers in the under the question. And there is a radio button on the side. You can just choose the answer. There are about 8 questions. Yeah. All right. So I think the first question we had was, where do people see index by the end of this year? Currently, it is at around 11,000 level, and the majority thinks that it will be plus 5%, in the range of 5 to 15%. So yeah, I think power to you, Akbar. It's up to you to drive the performance now. Start buying. Brent crude, people do still see an upside and slight downside also. So majority of people responded that it will be in the range of -10 to +10% from now onwards. Majority of the respondents are more interested in Qatari equities and then global equities and then gold as well. Very few people, or actually just 2% of the people want to remain in cash, which is a good news for all of us. 44% of the people want to invest through ETFs and 38% are unsure. Only 18% are clearly saying no. So I think there is an opportunity to convert this 38%, which is iffy about it, to start investing through ETFs. Most of the respondents are interested in growth in terms of investing in companies, which is, I think, in line with their expectation for the Qatari equities to go from 5 to 15% further from this point. In terms of what matters to the people, whether it's environment, society, governance, or all the above, 64% said that all the above matters to them, which is a good sign. I think last time when we did this last year, a lot of people were focused only on governance. But this year, it's 64% who care about all the three components of ESG. Then 18% care more about environment. As an investor, are you concerned about climate risk when investing in Qatar? 50% said yes, they are concerned about climate risk, and 30% said maybe. Only 20% thought that they are not concerned with the climate risk. And in terms of which climate risk is of greatest concern, carbon and water obviously are almost equal. 48% responded that carbon is the greatest risk, and 40% responded that water is a great concern for them. Natural disaster, people didn't actually, I think it's a function of where we live. Perhaps not a lot of people believe in natural disasters, but anyway. So that's about it. And we will be sharing the survey results on our social media platforms as well. So keep checking the updates on the social media. I once again want to thank everyone of the panelists who have joined. Raman, Stephen, Ahmed, Akbar, Leo, today for all your inputs and valuable time. We hope to continue with this partnership to push the agenda, the ESG agenda, because as we all have seen, ESG investing is here to stay. Thank you.